Look at your offer letter. It says you make $60,000 a year, $5,000 a month. Nice round number. Now look at the money that actually shows up in your bank account on payday. It's not $5,000. It's closer to $3,800. Somewhere between the number you were promised and the number that lands in your account, about $1,200 a month quietly went somewhere else. And nobody ever sat you down and explained where. That gap has a name. The big number, the one in the offer letter, is your gross pay. The smaller number that hits your account is your net pay, your take-home. And the distance between them isn't random, and it isn't a mistake. It's a stack of specific, predictable cuts, taken in a specific order, before a single dollar reaches you. Here's the thing most people never realize. That $1,200 didn't disappear into a black hole. It went to name places. A slice to Social Security, a slice to Medicare, a slice to federal income tax, maybe a slice to your state, and a slice you actually chose, like your own retirement, which isn't lost at all. It just moved into an account with your name on it. So today, we're going to read it together. We'll walk the whole waterfall from gross down to net and label every single cut along the way. Because once you can see exactly who's taking what and why, you stop being surprised by your own paycheck and you start being able to do something about it. No jargon, just the mechanics. Let's start with the two numbers because almost everyone confuses them. And the confusion costs real money. Gross pay is the sticker price of your job. It's your full salary before anything is taken out. $60,000 a year, $5,000 a month. That's the number recruiters say out loud, the number on your offer letter, the number you tell people when they ask what you make. It's also the number you do not get to spend. Net pay, your take-home, is what's left after every deduction comes out. It's the number that actually hits your checking account. It's the number that pays your rent, buys your groceries, and covers your car. And it is always smaller than gross. For a lot of people, meaningfully smaller, often somewhere in the range of 70 to 85 cents on every gross dollar, depending on their tax situation and what they have taken out. Here's why this matters in real life. Say you're apartment hunting and a landlord wants your rent to be under a third of your income. If you do that math on your $5,000 gross, you'll convince yourself you can afford about $1,600 a month in rent. But your real spendable money is closer to $3,800. Run the same one-third rule on that, and you can comfortably handle more like $1,250. People budget against the big number, then wonder every month why the math doesn't work. The big number was never yours. So the mental shift is simple but powerful. Gross is what you earn, net is what you keep. From here on, when you think about what you can actually afford, you think in net. Now let's walk down the stack and watch gross turn into net, one cut at a time. The very first cut out of your paycheck isn't income tax. Most people assume it is. It isn't. The first thing taken is a tax almost nobody explains by name, FICA. FICA stands for the Federal Insurance Contributions Act, and it funds two programs you'll lean on later in life, Social Security and Medicare. It comes out of essentially everyone's paycheck, and it comes out before income tax even enters the picture. Here's the breakdown. Social Security takes 6.2% of your pay. Medicare takes another 1.45%. Add those together, and you get 7.65%, your total FICA bite as an employee. Let's put it on our paycheck. 7.65% of $5,000 is about $383 a month, gone before anything else. Over a full year on $60,000, that's roughly $4,600 to FICA alone. A few details worth knowing, all current for 2026. First, your employer pays a matching 7.65% on top. On paper, that's the company's cost, though most economists think workers ultimately bear a lot of that. Employer have too, through lower wages. Second, the Social Security piece only applies up to an annual income cap, which is $184,500 this year. Earn above that, and the 6.2% Social Security portion stops for the rest of the year. The Medicare 1.45%, though, has no cap at all. It applies to every dollar you make. And remember, that cap number resets every January. The key thing to understand, FICA is not optional, it's not based on a form you fill out, and it's not the same as income tax. It's a flat automatic slice off the top. For most beginners, This is the cut that explains why your take-home felt smaller than you expected, even before tax season ever comes up. After FICA comes the cut, people actually think about income tax. And there are usually two layers of it, federal, and in most states, state. Start with federal. The money taken from each paycheck for federal income tax is called withholding. It's your employer's best estimate of what you'll owe for the year, sliced into every paycheck so you don't get one giant bill in April. And the dial that controls that estimate is a form you filled out on day one and probably forgot, the W-4. Your W-4 tells your employer how much to hold back. Claim more dependents or deductions on it, and less tax comes out of each check. Bigger paychecks now. Claim less and more comes out. Smaller paychecks. But a bigger refund or smaller bill later. This is the lever behind one of the most misunderstood ideas in personal finance. A big tax refund is not free money. It just means you had too much withheld all year and lent it to the government, interest-free. A refund is your own money coming back. Now the rough numbers. Federal income tax is bracketed. We'll go deep on that in another video. But for a single person earning $60,000, the federal tax you actually owe for the year works out to roughly $400 a month. Your real per paycheck withholding can run a bit higher than that, which is exactly why so many single filers end up with a refund. On top of federal, most states take their own cut. State income tax varies wildly. A handful of states, like Texas and Florida, take 0, while others can take 5% or more. For our example, call it roughly $200 a month. Illustrative, because your state decides this. The takeaway: income tax is the biggest variable in your whole paycheck, and the W-4 is the one part of it you actually control. Most people set it once and never touch it again, which means they never tune the single biggest dial on their take-home pay. Now we get to the cuts that are different from all the others, because some of them actually work in your favor. These are deductions, and they split into two kinds: pre-tax and post-tax. Understanding the difference is one of the highest value things a beginner can learn. A pre-tax deduction comes out of your pay before income tax is calculated. That's the magic word, before. Because it lowers the amount of income the government gets to tax, it shrinks your income tax bill at the same time. The classic examples are your traditional 401k retirement contribution, many health insurance premiums, and an HSA, a health savings account. But here's a detail almost nobody tells beginners, and it's the most useful thing in this section. These pre-tax cuts are not all equal. A traditional 401k lowers your income tax, but you still pay the 7.65% FICA on that money. An HSA and most workplace health premiums skip income tax and FICA, so per dollar they're an even bigger break than the 401k. Here's the worked example. Say you put $200 a month into a traditional 401k, that $200 isn't hit by income tax this year. For our single $60,000 earner, the realistic income tax saving is about 16%, federal plus a typical state. So the $200 costs you roughly $168 of take-home and saves about $32. If your combined income tax rate were higher, say 22%, that same $200 would cost only $156 and save $44. Either way, you moved money into your own retirement account, and the government taxed less of it. Just remember, the tax is deferred, not erased. You pay it when you withdraw in retirement. For context on how much room you have, both 2026 figures. You can put up to $24,500 into a 401k and up to $4,400 into an HSA for self-only coverage. Those limits rise most years. A post-tax deduction is the opposite. A Roth 401k contribution is the common example. No tax break today, because you already paid the tax, but qualified withdrawals later come out tax-free. The one idea to carry out: pre-tax deductions shrink your taxable income, so part of what looks like a cut is really money you're keeping, just moved somewhere the taxman can't touch yet. Now let's put it all in one place and watch the whole thing fall, top to bottom. This is the paycheck waterfall, and once you've seen it once, you'll read every pay stub for the rest of your life. We start at the top with gross pay, $5,000 for the month. That's the diving board. First, your own pre-tax choice, because it really does come out before income tax. Say $200 into your traditional 401k. That money leaves your paycheck, but stays your money, sitting in your retirement account. And it lowers the income the government gets to tax, which trims the tax cuts that follow. Next, FICA. 7.65%, about $383, comes off for Social Security and Medicare. One honest note, FICA is charged on the full $5,000. The 401k does not shrink it, which is the catch we flagged earlier. Then federal income tax, for our single earner about $400, already a touch lower because the 401k shrank the taxable base. Then state income tax, illustrative $200, or zero if you're lucky enough to live in a no-tax state. Land it all up, and you're right around $3,800 in actual take-home, plus $200 more sitting in your 401k with your name on it. Look at what just happened. The genuinely gone forever money was the taxes. Social Security, Medicare, federal and state, roughly $1,000. The 401k piece left your paycheck but stayed yours. That distinction is everything. Some of these cuts are the cost of running the country, and some are just you paying your future self. That's the entire machine. Gross at the top, a fixed order of cuts in the middle, net at the bottom. Nothing hidden, nothing random, just a stack you can now name line by line. Let's bring it together. Your gross pay is the sticker salary, the big number on your offer letter. Your net pay, your take-home, is what's actually left after a predictable stack of cuts, and it's always smaller. The first tax out is FICA, 6.2% for Social Security plus 1.45% for Medicare, 7.65% total, taken before income tax even starts. Then comes income tax, federal, set by the dial on your W-4, plus state in most places. And finally your own deductions, where pre-tax choices like a traditional 401k, health premiums, or an HSA shrink your taxable income, while a Roth doesn't lower today's tax but pays off later. Remember the nuance. The 401k still pays FICA. The HSA and health premiums skip it. The single biggest takeaway is this. That gap between gross and net is not a mystery, and it's not fixed. It's a stack of named, ordered, mostly predictable cuts, and the moment you can read your own pay stub line by line, you can start to optimize it. You can tune your W-4 so you're not handing the government a free loan all year. You can turn pre-tax contributions into a tax break and a retirement balance at the same time. The same paycheck that used to just confuse you becomes something you can actually steer. Reading it is the whole first step. If this finally made your paycheck make sense, if you'll never confuse gross and net again, and you're already itching to go check your own W-4, hit subscribe. That's the entire point of this channel. The money mechanics nobody ever bothered to explain in plain English. And since we kept saying federal income tax is bracketed and promised to come back to it, that's exactly where we're going next. Video 13 breaks down how tax brackets actually work, including the most common myth in all of personal finance, the one where people genuinely believe a raise can push them into a higher bracket and somehow leave them with less money. It can't, and once you see why, you'll never fear a raise again. I'll see you there.